My pleasure. Thanks very much. You know, as Gary said, the timelines on the presentations are tight. So I've been given 30 minutes to summarize everything going on in the global economy, the US economy, the Canadian economy, financial markets, and make sense of all of this and give you forecasts. So as you might expect, I'm gonna be a little brief on some of these things, right? But the purpose of this session is to give you, a snapshot overview of what's transpiring. And the title of the presentation might sound a little odd, but you're going to find out that really what we're talking about is where are we in the business cycle? What are the risks related to a recession? How should businesses be responding to increased talk about potential downturns? I'm also going to talk about the fact that politics is actually the source of all of the biggest economic risks. And that actually creates a real problem. Right? Because from a forecasting point of view, boy, is it hard to predict what's going to happen on the political stage. So I really think you need to think about scenarios. So, what's the dominant economic story playing out at the moment? Well, the main theme is that the global economy has lost momentum. Last year, the global economy was growing at 4%, which is actually a robust pace of economic expansion. But over the course of this year, the pace of global growth has dropped to around 3%. And that might not sound like much, but keep in mind, you've lost a quarter of your rate of expansion. And to put it in context, a typical global recession is one where the world economy continues to grow, but it grows at about 2%. So when you go from 4% growth to 3% growth, it's like the global economy's immune system has gotten run down, right? It's now much more vulnerable to any future shocks. So, we haven't had a downturn, we've had a moderation in growth, but the economy's fragile. Now, you might ask, so why did this happen? And part of the answer is actually healthy and normal. It actually isn't negative. In 2016, 2017, and heading into this year, in the advanced world, there was very strong economic growth, and it was creating tons of jobs, and unemployment rates were coming down to record lows. So in the United States, the unemployment rate hit a 50-year low. In Canada, it was a 45-year low. In Europe, unemployment rates were coming down, right? And that was happening through 2018, and this led central banks to start thinking about normalizing interest rates. And the Federal Reserve raised rates, and the Bank of Canada nudged rates higher, not as much as the US. The European Central Bank said it was planning to shut down its bond buying program. So if you're running out of economic slack, it's a little like your economy is running a marathon and you find you're sprinting a bit too fast, right? What do you do in that environment? You slow down the pace you're running so you can make it to the end of the race. And you wouldn't say that's negative, right? You would say that's like natural or healthy. So part of the slowdown was actually a byproduct of tightening monetary conditions and diminishing economic slack. But then something else happened that was very corrosive and was very damaging and made the slowdown much more pronounced and actually increased the risks of triggering a turn in the business cycle. And it's the byproduct and the fallout of nationalism and populism. So if you go back 3 years ago, we had two big events that characterize or are good examples of how populism and nationalism have had an impact. So 3 years ago, the UK voted to leave the EU, right? And for the last 3 years, they've been trying to negotiate Brexit. 3 years ago, President Trump was elected. And with President Trump, he brought in a lot of US protectionism. And at first, it was global in nature. He applied tariffs on steel and aluminum globally. And then he went to embark on a trade war with China. And the impact of protectionism and the uncertainty created by things like Brexit has dampened economic growth in a meaningful way. In point of fact, it's probably responsible for about close to 1 point drop in global economic activity. And the way it's manifested is that we have seen globally manufacturing is no longer growing. If you look at the purchasing manager indexes that are the sort of highest frequency data, they get published sooner than other data. So we watch them very closely. what you can see is that in the spring, the purchasing manager indexes in manufacturing in Asia and Europe, in the spring they turned negative. They went below 50. That means that signals contraction. And in the last 3 months, the US ISM manufacturing index, which is a purchasing manager index, it dropped below 50 as well. So global manufacturing has gone into a slump. And this is actually where we're seeing the bulk of the economic weakness. Now, this actually hasn't caused a turn in the business cycle. We actually haven't had a recession because if you look in advanced economies like Canada, the United States, the manufacturing sector is, it's like 10, 12% of the economy, right? The bulk of the economy is actually services. And so the key question has been, would the weakness in manufacturing ultimately infect services to the point that we actually had a recession? And so this was what markets were worried about. This is why at this time last year, the equity market was suffering through a correction, and we actually had the worst equity market in December on record last year. So heading into this year, markets were absolutely convinced we're headed for a recession, right? So what actually happened, right? We actually had a slowdown, and this happened in the context that the bond market was basically signaling terrible times, right? So we had a situation where there was an inversion in yield curves in North America. And the thing about it is markets know every recession has been accompanied by an inverted yield curve. Well, that makes you feel a little queasy, right? So if we've had an inverted yield curve, why haven't we seen a recession? Well, it turns out that there is a caveat. So every recession has been accompanied by an inverted yield curve, but not every inverted yield curve has been accompanied by a recession. So in point of fact, you actually need confirmation from other indicators. It's not enough that the yield curve inverts. I also think it's extraordinarily difficult to actually interpret the yield curve at the moment. And the reason for this is fixed income markets never normalized after the last financial crisis. Right? So low rates have meant that now we have $250 trillion of global debt. And 17 to 20 trillion dollars of that is actually trading with a negative yield. Right? So earlier, when markets were a bit more negative a few months ago, we actually had 25% of all global debt, government and business debt, trading with a negative yield. That is, economists like myself before '08 used to talk about there being the zero lower bound, like interest rates couldn't go negative. Well, turns out we were wrong. Yes, they can. In fact, in Denmark, you actually have negative mortgage rates. You buy a house, the bank pays you for taking out the loan. Okay, this actually makes your head want to explode, right? Like, how the hell can that be? Well, it turns out you can actually have that if you have a negative deposit rate. So a good question would be, how the hell can you have a negative deposit rate? If the bank's going to charge you money to deposit, why would you put your money in the bank? Well, in point of fact, it turns out that there's an opportunity cost. So if I'm a company in Europe and my company's doing well and profits are rising and income's coming in, what am I going to do with the money if I don't put it in the bank? Right? I have to go buy a vault. I have to buy security. I basically have to, it's going to cost me money to store my money. And what we've seen in Europe is, in point of fact, the cost of storing money turns out to be about 70 basis points. If we get a negative deposit rate close to, we can't seem to get a negative deposit rate above 1%. Because once you get to -1, it's like, well, okay, now it's worthwhile to actually go buy the vault and buy the security. But at 70 basis points, companies are like, well, I got to store my money. If that's the cost of storing money, okay. This is still, so there's a logic. Oh, and how can you have a negative mortgage rate? If your negative deposit rate is bigger than your negative mortgage rate, it actually, the bank makes money on the spread. So there is actually a logic to the insanity. But if you have a world where interest rates, where when the U.S. yield curve inverted, the 10-year bond was trading in the U.S. at 1.4%, and you said, well, why would an investor buy that? when that's less than the rate of inflation? And the answer is, well, you might still buy that bond if your alternative is a German Bund offering, minus 0.8. In fact, that makes that US bond actually look quite attractive. So I think it's very hard to interpret signals coming out of the fixed income market because this is such a strange and atypical world in which we are currently living in. I do think the drop in the yield curve was telling us something about prospects for growth. I think it was consistent with the global slowdown that we've been seeing. Now, in response to increased global risks and slowing growth, we've had central banks around the world cutting rates. Not the Bank of Canada, but the Federal Reserve has cut rates now 3 times. About 26 other central banks have been easing monetary policy. And from a Canadian point of view, that's beneficial to us because globally interest rates came down, and that basically means Canada indirectly benefits from, for example, lower bond yields because Canadian bonds will trade as a spread to US bonds. So even without the Bank of Canada cutting rates, we've actually seen some reduction in borrowing costs in Canada. And globally, what's happened is central banks have been taking out an insurance policy to try and ensure that the downside risks don't become too acute. Now at this stage, I think that the Fed's done cutting rates. So our forecast is basically from here, unless the negative risks intensify, we think that central banks are probably done easing policy. And if you look at what's been happening in the equity market, we've had a lot of volatility, right? You can see the December correction there, shows you just how terrible it was. But since then, it was like the market is always a tug of war between the bulls and the bears. And boy, the tug of war has been really acute. And what's been really happening is when it looks like Brexit is becoming more disorderly, it's not clear, you could have a UK hard exit. When it looks like the trade talks with China are going worse, or when President Trump threatens to apply more tariffs, the market sinks. And then when central banks cut rates and when the economic numbers come in, that continue to show growth, the market bounces higher. And of course, the other dimension here is you actually can't accumulate wealth through fixed income products. So there is a quest for yield happening, driving people into riskier, into equities and other assets. Now, one of the things I think has been having impact on market psychology around the economic risks is that when they were seeing, as they started to see a slowdown in global growth, I think there was a sense that a lot of investors felt like we were due for a recession. And the reason for that is that we had recessions in the early 70s, early 80s, early 90s, 2001, and 2008. So statistically, we have recessions about every 8 to 10 years. Okay, so how long ago was the last recession? Oh dear, right? I have no idea why they put these presentations first and after breakfast, right? All I'm going to do is upset your tummies, right? So we have recessions, roughly every 8 to 10 years on average. But understand that it's not a calendar event, right? So this is now the longest economic expansion on record. We are definitely late in the business cycle, and things like the low unemployment rate and the shape of the yield curve and a lot of other indicators tell us, we're not at the start of a business cycle, we're not in the middle, we're definitely, in the later stages. But recessions are not like calendar events where you turn the calendar and it says, it's now been 10 years plus 1 month, you must have a recession. That obviously is not the way it works. So if you study business cycle theory in university, what they tell you is that the Western capitalist economic system always creates imbalances, right? So what happens, this is because markets are not perfectly efficient. It's because investors and market participants don't have perfect and full information. It happens because you can get periods where you get some irrational behavior in terms of pricing. So you get some speculative effects. Then you have government regulation that messes with market outcomes. So there's a lot of things that actually mean that you aren't going to get a perfect market outcome. And that means over time you can develop imbalances. And what determines your business cycle and how acute it is how big the imbalances are that build during your expansion. Right? So in 2001, during the tech wreck, right, what actually happened was we had overvalued tech stocks. And when their prices were adjusted and markets responded, it was bad enough to actually cause the US economy to contract for 2 quarters. So the US had a recession, but it was incredibly mild and very short. Why? Because the imbalances were concentrated in just one small area. 08-09 was the dead opposite. 2008, 2009 was the perfect storm, because what you had a huge housing bubble in the United States that then was compounded by the introduction of all these new financial engineered products, structured products, financial derivatives that markets hadn't figured out how to actually price properly, and regulators didn't appreciate the risks of. And then you had a financial system that was undercapitalized. And so when you repriced the value of those assets, the financial system didn't have enough capital to absorb it. And so 08-09 threatened to bring down the global financial system. So understand that 08-09 environment was, in my mind, a 1 in 100 year type event. Like if we had not gotten the central bank stimulus and the government stimulus that occurred, we really could have had a depression, right? We could have had a 1930s style depression. So people often are not happy with the outcome that we've had over the last 10 years. A lot of times people talk about, oh, we're trapped in a slow growth environment. Understand, this has been the good scenario, right? And so I don't think the next turn in the business cycle is going to be anything like 08-09. But you have to think about, okay, so where are there imbalances, right? And how big are they? And in my mind, the biggest imbalance is the amount of leverage the global economy has in fact accumulated. It makes it more vulnerable. But it's not posing the same sort of threat that the subprime mortgage and asset-backed security issue was. So at some point down the road, we are going to have a turn in the business cycle, right? It could be, I don't think it's going to be 2020. It could be 2021. It could be 2022. But I look at a lot of high-frequency data to assess how things are going. And please don't stretch your eyes. So just look at the colors, okay? So this is a heat map, and it's a dashboard I use that looks at leading economic indicators. And it tells me whether the economy's sort of losing momentum, stabilized, or growing. And in November, December, and you can sort of see it in the middle here, man, there was a lot of red, right? And that's when the market was braced for a recession. Then this year, it actually became quite mixed. And if you look in recent months, you can actually see green on this chart. So in other words, there's a lot of indications that growth is continuing. So worst fears have not been realized. We've navigated the political risks as well as we can. But we are still in a risk-filled environment. So we're likely to continue to have growth, but at a modest rate. We just need to be mindful of the fact we're late in the business cycle. From a Canadian point of view, what we've seen is, and let me back up. So I mentioned that the big risks that have come have been driven by populism and nationalism. We're still dealing with the Brexit. We're still dealing with the US-China trade dispute. Understand that those things can be resolved in either direction in terms of being positive or negative, right? So the negative world would be if things don't go smoothly in the UK and they have a hard Brexit, you could drive Europe into recession and hurt the global economy. On the other hand, we're going to have an election on December 12th, and if the current government gets a majority, then the current deal they've got with the EU is probably going to get pushed through, and we'll have a soft Brexit. And that risk will diminish, and markets will react positively to that. Similarly, the trade war with China, it could escalate. We have a hard time predicting what President Trump's going to do. Right? So it could escalate, and if he applies tariffs on all the Chinese products, the downside risks the world economy go up greatly. On the other hand, he's going to stand for re-election. I'm going to put aside the impeachment process because I have no idea what it actually means regarding his running again. Plus, I don't think they don't have enough time to do the impeachment. So I think ultimately Trump's going to run for re-election. And the one thing I know is what will President Trump do? President Trump does what's best for President Trump, right? And so it's in his interest to resolve the trade dispute before the next election. Because imagine what a coup it would be if he goes back to the electorate and says, I renegotiated NAFTA and I renegotiated trade with China, right? That would be big wins for him. So in my mind, there actually is an argument that we could actually see a resolution, or at least an agreement not to have it escalate any further before the next election. And that would actually give an upside to the economic outlook. So the political risks can go in either direction. When we look at the Canadian economy, we've had a lot of volatility in economic data. We actually almost posted no growth in the fourth quarter of last year and the first quarter of this year. And then in the second quarter, we got 3.7% growth, like a huge increase. You have to average this out. If you look underneath the surface, the Canadian economy is growing at about 1.5%, which is a subpar performance. It's not terrible, but it's a subpar performance. Where we're seeing the weakness in industries was construction, the oil and gas sector, and manufacturing. But the construction sector is actually stabilizing as we're seeing signs that Canadian real estate markets are coming back up. Like Vancouver home housing has stabilized. Southern Ontario house markets have jumped back up. So the weakness in construction was very much tied to the softening in the real estate. But housing is no longer acting as a drag on the economy. The oil and gas sector is still struggling with the low prices. The manufacturing sector in Canada is being hurt by the global slowdown in manufacturing, but it's actually doing better than most. And this is where I think we could actually see more weakness, because I think through global supply chains, particularly US supply chains, we're going to start to see more weakness in the Canadian manufacturing system. But services continue to grow at a strong pace. When we think about imbalances, the one that gets the most attention is household debt. And you look at, this is a chart the Economist magazine loves to run that shows the debt to income ratio, and it's like, oh, debt to income is near 170%, and you can see where the peak was in the United States. Okay, this looks scary, right? This is the worst statistic that we've ever created, right? Like, I don't know whether I can use the joke anymore, but I used to call it the Don Cherry of economic statistics, because it's very loud in your face and doesn't really mean much. Right? So the debt to income rate, anybody who works with financial numbers knows you don't compare a stock to a flow. And this is the stock of debt divided by the annual flow of after-tax income. You don't do that. You look at a stock to a stock or a flow to a flow. Right? So you're comparing apples to oranges to start with. Number two, the denominator on this includes, so the numerator is all the debt, obviously. But the denominator is all the income of people with debt, but also all the income of people without debt. So if I actually take away the income of people that don't have debt, this ratio is over 300%. So I don't actually know what 170 actually means. All it really tells me is that Canadians did increase their leverage. But if you actually want to know about the economic consequences, you have to look at something like interest and principal payments relative to income, and it paints a different story. Right? So we had a big run up before the recession, then it stabilized. And then you'll see the payments went up at the tail end, but that was because the Bank of Canada was raising rates. But the Bank of Canada is not going to raise rates any further, right? So on the household debt, I think that there's a lot of confusion about the nature of debt. If you actually dig into this, where the vulnerability is, it's really about 8% of Canadian households that have stretched their finances to the absolute limit. So it's not the majority. It doesn't pose, I think the biggest risks associated with household debt is that if you have a recession and you have a downturn and an increase in the unemployment rate, consumers are likely to actually cut their spending more. But we're not going to see something like the US experience because of the sort of statistics that we're currently seeing. Overall, if we think about the Canadian economy, growth this year is going to be about 1.5%. If the political risks don't really change and we just stay sort of where we are. We have maybe a soft Brexit and the trade dispute with China doesn't escalate, but it doesn't disappear. Growth next year is probably going to come up to about 1.7, 1.8%, and that's what the Canadian economy can actually sustain over the long haul. That's our idling speed. And you might be disappointed by that, right? You might say, well, geez, like 1.7% growth is really low. Well, it is low compared to the past, but it's because of the structure of our economy. So what's happening is we have aging baby boomers. Baby boomers are now leaving the labor market, so labor force growth is slowing. Your economy grows either because you have more workers or you use your workers more productively. Labor force growth is slowing. This is pulling down the rate of sustainable economic growth. If beyond how many workers you have, the other thing you can do is you have workers that are more productive and can produce more. And this is the trend in Canadian productivity. So you can see the problem here, right? We have declining productivity growth, we have declining labor force growth. So when I started my career in the early 90s, we thought the sustainable rate of growth in Canada was 2.8%. So round that up to say 3 for dramatic effect. Right now, we think the sustainable rate of growth in Canada is 1.7%, so round it to 1.5. You've basically lost close to half of your sustainable rate of growth because of structural changes taking place in the economy. And so we desperately need to change the path we're on, because if we look at sustainable rates of growth across this country, they're going to drop, and they're going to drop in every region. And in some places, it's particularly acute, like in Atlantic Canada, because their demographics are worse than the rest of Canada. Right? In New Brunswick right now, deaths outnumber births every single year. Right? So your sustainable rate of growth is slowing. And if you take your rate of growth and you add inflation, that's how fast income in the economy will grow. Right? So if your growth rate is going to be 1.5 and you add 2% for inflation, income is only going to rise at 3.5% per year. In the 90s, it would rise 5% per year. And that's what governments tax to pay for social priorities. But when you look at social priorities like healthcare, it's going to be extraordinarily difficult for governments to actually meet their fiscal commitments. And this is a fundamental problem, particularly from a business point of view, because what do you think is going to happen if they actually need more money? Right? So we actually need to change the path we're on, and that means we actually need to have constructive conversations within the business communities about how to become more innovative, how to encourage businesses to invest more in capital. We also need to talk to governments about how to improve the environment, the policy environment in which businesses are operating. So Canadians hate the word productivity, right? It's the longest four-letter word in the English language. Right? Because Canadians think productivity means working harder or producing more with fewer workers. In point of fact, since the end of the Second World War, 80% of the rise in the standard of living of our people has come because we've become more productive. It is the source of a rising standard of living. So if people don't like the word, what do? Well, you change the word. So we don't use the word productivity in the public. We use the word competitiveness. Right? So everybody agrees we should be competitive, right? But if you look at the World Economic Forum competitiveness index and you look at the fine print and it says, what is competitiveness? It says the productivity of each country, right? So we looked at Deloitte, we looked at, how does Canada do on the competitiveness scale? And our strength is talent, our people. We have the most educated, we actually have the most educated population in the OECD. Amongst all advanced economies, we get more people get post-secondary education in Canada than other countries. So our strength is our people. Where we really fall behind is we're below average on infrastructure, so we have infrastructure gap. So we actually need more investments in infrastructure. But the areas we're weakest is innovation, taxation, and regulation. And regulation is by far the worst. Right? So innovation is businesses in Canada are reluctant to invest. They're very cautious with their balance sheets. We don't do as much R&D. We don't generate as many patents. We don't have as many entrepreneurs as a share of our population. We need to do better on the innovation. On the tax side, tax rates in the United States have plunged, and Canada has gone from having an advantage on business taxes to having a disadvantage. and our personal income taxes are, when your marginal tax rate's above 50%, you actually are causing harm to your economy, because you actually induce people to make choices like I'm not going to work as many hours because like as a doctor it'll be I'm going to spend an extra day on the links, right? If you're not going to give me at least 50 cents on the dollar for what I do. So from a tax point of view, we have a tax competitiveness problem, and then there's the regulation side, and the regulation side is really a problem. And if I was in Alberta, they think I mean pipelines, and pipelines is certainly part of the story here. But if you think about it, so in Toronto, it takes 256 days to get a permit to build a warehouse. That is 168 more days than in the United States. For heaven's sakes, why would it take that long to get a permit to build a warehouse so you can grow your business, right? In BC, the Port of Vancouver was running out of capacity, and it needed to increase capacity. So they figured, it would take 3 years to get permitting, 2 years to do the build. The port facility would get expanded in 5 years. They got the permit I think they got the permit this year, and if they move forward with construction, it will take 10 years to expand the port. And this is our gateway to Asia and where how we try to diversify trade. So regulation is a fundamental challenge. And I suspect regulation is a challenge for your sector as well, right? And this is part of the role of the association, is to talk about things like this. So that's my whirlwind overview. I hope I haven't depressed you too much. Right? What I'm telling you is it's a risk-filled economic environment. I think that there's going to continue to be concerns when you get negative news that we could be at a tipping point in terms of the business cycle. I can tell you that the economic data I'm looking at is telling me that we're going to continue to have economic growth. But I am worried about political risks. And so I think you need to think about different scenarios and how your business would be affected by different economic environments. And then I'd like to stress to you why you should all be basically championing that Canada needs to become more competitive, both on the side of businesses becoming more competitive, but also engaging with governments to help to find ways that we actually can create a stronger policy environment to support stronger economic growth. Because quite frankly, I'm very concerned about the path we're on. So with that, thank you for your time and attention.